Tavern on the Green in New York's Central Park, the 20th anniversary of Wall Street Week with Louis Rukeyser is made possible by the financial support of viewers like you. By the Travelers, insurance and related financial services working to provide financial peace of mind for American business. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. and the Enron Foundation. And by Prudential Bates Securities. Rock solid. Market wise. Produced Friday, November 16.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. And welcome to our very special 20th anniversary celebration, coming to you from New York's Tavern on the Green, a setting that seems particularly appropriate tonight for two reasons. Green, because we will be talking, as always, about money and how you can get more of it, and Tavern, because we will also be talking about the state of the U.S. economy. And by the time we're finished, you may well feel the need for a tavern. I'll drink to that. All week long, people have been asking me to explain the reason for our longevity and success, but I think the real answer to that one is perfectly simple. Clearly, it is because we have solved all the problems of the American economy. Just think for a minute of what we would be seeing today if Wall Street Week hadn't been looking out for your interests over the past 2 decades. Why, just for starters, if we hadn't been here, the U.S. dollar would be weak, interest rates would be high, the federal deficit would be growing, and the politicians would be getting ready to raise your taxes again. Thank goodness we've managed to put all that behind us. So I don't know what's even left for us to cure in the next 20 years, but we'll keep on trying. With me here in Central Park tonight are about 350 of our very closest friends, including many of the folks viewers have said were their favorite guests and panelists over the years. And I'll be chatting with some of them in a moment. First, though, a quick look at the week's economic news, which was dominated by one thing that didn't happen and one thing that did. The shoe that failed to drop was war in the Middle East, as the so-called smart money concluded with its usual confidence that an attack on Iraq was not imminent after all. And so the world oil price fell back below $30 a barrel. What did happen, on the other hand, was that the Federal Reserve Board, which appeared in recent years to be operating under the delusion that prosperity causes inflation, looked around this week and acknowledged, presumably with approval, that the prosperity has indeed now satisfactorily disappeared. So it's finally okay to start lowering interest rates. Better late than never, the bond and stock market sighed, and both those depressed areas staged minor parties of their own. Stocks were helped, too, by some internal factors. For example, many technicians purported to have perceived what they delight in calling a head and shoulders bottom, thereby naming 2 parts of the human body that are rarely used in Wall Street. But who knows what will be top of the charts next week. So let's check out the good news while it lasts. And as the Dow Jones Industrial Average indicates, signs that inflation might be less fearsome than previously believed, combined with the reality of lower interest rates and oil prices, to send stocks to their best levels in 2 months. The blue chip index picked up nearly 62 points to close at 2550.25. And on rising, though still not impressive, volume, all the broader indexes showed gains for the week, too. Bear market rally or the start of something big? Our 10 chief elves remain totally divided on the market's technical outlook for the next 6 months, netting out to a big fat 0. And you can be sure that at least one of them will be right. The week's losers included gold, silver, the dollar, and the American consumer, whose confidence in the economic future has fallen in the past 3 months at record velocity. Meanwhile, back in the entertainment capital of America, Washington, D.C., neither Republicans nor Democrats seemed precisely euphoric. From the White House came word that President Bush, looking ahead to still another tax debate next year, was spending hours in front of a mirror learning how to read his own lips. While on Capitol Hill, the savings and loan scandal produced a new definition of a liberal senator, one who is liberal as to whom he'll take campaign contributions from. So, as they say, the beat goes on, and two of our own best beloved drummers over the years have been Frank Cappiello and Carter Randall, both of whom appeared as panelists on our very first show on November 20th, 1970, and have been frequent guests ever since. Gentlemen, what's the most important thing you've learned over the past 20 years?
Well, two things, Lou, I think. Patience and humility.
Which was the easier lesson?
I think humility.
Carter, what's your answer?
I didn't learn either one of them very well, as a matter of fact.
See, Carter's never humble.
That's right. But I'm going to give you a serious answer. One of the big things I've learned is that the American people really don't understand the capitalistic system as well as they should. And programs like this do perform a service to help them to understand it, stimulate their thinking. And I'm very proud of being a participant in that.
Well, we're proud that you've contributed to that education.
Thank you.
Frank, what do you think is the mistake people have tended to make over the years? What should they not have done that they did do?
Well, I think they don't stay with good stocks long enough. I think there's been a tendency increasingly, as markets become more volatile, to switch to something that they think is better. And the mistakes that we've made is not in doing our homework up front, but in not trusting our instincts and staying a little longer. When you buy a good stock, unless something goes wrong basically with the company, don't worry about the market. I think there's too much concern about the ups and downs of the market. And essentially you make money by being a stock picker, not by being a market analyst. At least that's been our experience.
Carter, as a good fundamentalist, you probably agree with that as well, do you?
I agree with that, but I also think most people think the stock market is one great big casino. It's not. It's a place in which to invest your money and own a share of America and make money over a period of time.
Well, that doesn't make you a technician then, because
It sure doesn't.
the technicians explain that they're able to call next week's move of the market, and you should play that for what it's worth.
Well, that's where indeed I have learned humility. I am not able to call next week or next month, but I can call the next 3 to 5 years.
In 20 years, we haven't taught you any humility?
No, not on that subject.
We're going to have, I don't know how many more years, but if we had 20 more, Frank, where would you expect to see the economy and the markets?
Well, I think the first, I guess the next couple of years will be a little tough for the economy, but I would expect by the end of this decade, by the end of the first 10 years of this decade, or rather the first 10 years of the next 20 years, I'll be all right.
Alternatively, the last 10 years of the decade.
For the first time, I've got cabin fever. I would expect that the American economy will be slower, but I think the European economy will probably be the star of the world, and particularly Germany. I think Germany will be the one story that you can rely on in terms of the stock market and the economy. I also,
just as we were looking to Asia for the last few years, we'll start looking to Europe?
I think the Pacific Rim up to the year 2000 won't be much. I think it'll be Germany. Beyond that, I think maybe China will intervene. So if we have another 20 years of Wall Street Week, and I think we have, you may be here but I won't, I think we'll see Germany resurgent, China later, but America surprisingly will still be number 1. Germany may be number 2, and Japan may be number 3. And you make your market calls accordingly.
We were all in high school when we started. We'll all be here in 20 years. How about you, Carter? What do you think?
I'm going to be here 20 years from now, if asked. And in the year 2010, Lou, the Dow Jones Industrial Average is 10,000.
Exactly 10,000?
Well, 10,001.
Put that one down.
And how much inflation in the intervening period? I mean, we'll be able to buy more than a small postage stamp with the postage?
You might be able to make a telephone call with that, yes. Inflation averaging 4% per year compounded in the process.
So you're pretty optimistic about our future?
Of course.
Even though we don't understand the capitalist system the way we should?
No, I have always been optimistic about our system, and I intend to remain so.
Well, bless you both, and we look forward to hearing more from you over the next few years and decades. On the other side of the Atlantic, you know, a standard parlor trick is to recite all the names of the English kings and queens in order. We won't ask anyone to do that tonight with the names of all the guests on Wall Street Week, for we've now had 956 different programs with 695 different guests. But we thought you might like to recall who the very first guest was in 1970, and he's been gracious enough to come back tonight. Stan West is a consultant who retired 5 years ago as research director of the New York Stock Exchange. In November 1970, Dr. West talked to us about who the average investor was in America. Stan, how would you answer that question differently tonight?
Well, first of all, I'd say there are a lot more of them than there were in 1970. The last...
But are they richer?
They probably are because of what's happened to the market over those years. Actually, there's a new study coming out sometime before the end of the year with the most up-to-date figures. But the latest was 1985, and the number of share owners at that time was 47 million compared with 31 million when we first talked 20 years ago.
Those are people who own stocks directly.
Own stocks or stock mutual funds.
Okay, but probably half the country or more is involved in stocks through pension funds and other indirect ways.
Oh, yeah.
Insurance companies.
Exactly. But people who own mutual funds are probably more important now relatively than they were 20 years ago.
Why is that? The people were frustrated at doing it themselves?
I think it's a combination of things. All the new products and services that were developed in the financial industry in the last 20 years, which did not exist when we talked 20 years ago. Stock options, standardized options, financial futures, index trading, have kind of given people a sort of a discouraging attitude toward the market, and I think they feel more inclined to entrust their savings with professional management through mutual funds.
Well, this is the family hour on television, so I don't want to use an obscenity, but I have to mention program trading. Do you think that's scaring people out?
I suspect it has had a negative effect on people's attitudes toward investing.
Do you think the exchange is beginning to realize that? Because they talked for years as if it wasn't important, but the last few weeks they seem to be waking up.
From what I read, they seem to be getting the message.
Were you delivering that message on behalf of the individual investor when you were there, telling them they ought to bring him back?
Program trading really was not important when I left the exchange 5.5 years ago.
So you're not guilty?
So I washed my hands of it.
20 years from now, would you expect those numbers to be much greater?
If Carter's and Frank's forecasts hold true, I would expect a lot more individual share owners than we have
There's
currently.
a first time for everything, Stan. Thank you very much for being with us. In the years after Dr. West got us rolling, we've had many memorable guests from top government leaders here and abroad to some of the sharpest financial minds of the 20th century. Early this year, we asked viewers whom they would nominate as their own favorites for the new Wall Street Week with Louis Rukeyser Hall of Fame. 4 guests were honored in the first installation this year. 2 of them, unfortunately, are no longer living, but the other 2 are sitting together at this table by happy coincidence. Peter Lynch, who led the Fidelity Magellan Fund to the best record of any mutual fund over the past 15 years, and John Templeton, that giant of 2 generations of international investing, who reminded us that the financial world does not end where people stop speaking English. Peter, you retired in June at the ripe old age of 46. And that was 1 month before the Dow Jones Industrials hit their all-time high. Was this timing intentional? Were you just getting out while the getting was good?
No, obviously I had no idea what was going to happen in Kuwait. I think the most important thing I've learned in the last 20 years is what's happened to corporate profits. It's magic that in 20 years the Dow Jones average has tripled and the profits of the Dow Jones companies have tripled. There's a direct relationship with what happens to companies' earnings and what happens to their stocks. And that's the key thing over time.
Many people argue about whether markets are undervalued or overvalued. Are you suggesting then that they're usually fairly valued?
They're always fairly valued. When you look in the last 20 years, Avon Products and Sears, these were great companies 20 years ago. They've fallen 30, 60% in price in the last 20 years. And over the same period of time, Merck, Coca-Cola have had their profits go up 15-fold. And guess what? Stock's gone up 15-fold. So even if the Dow Jones today was 500, you would have been very happy to own Coca-Cola and Merck. So there's a direct relationship. That's what you have to concentrate on. There are people that own electronic stocks that don't know the difference between an EPROM and the senior prom, and they're trying to buy stocks. And the amazing part is the public is very careful with their money. When they buy a dishwasher, when they buy a TV set, when they rent an apartment, they're careful. When it comes to the stock market, for some reason, they just don't do any work. And it's not that much. A half an hour of work would save them a fortune.
What would they do in that half hour?
They would first of all see if the company has sales and profits. A lot of times they buy companies, there's nothing there. There's literally nothing there. Companies there's nothing to look at. when you look at most companies, you say to yourself, I'm going to tune in later on this company. I'll give you an example. Walmart started as a public company 1 month before the show. At that point, they had 37 stores. It was October of 1970. At that point, 10 years later, you could have tuned in to Walmart. Their profits are up 20-fold, and the stock was up over 20-fold. It still had another 10 years left. Profits went up 25-fold in the last 10 years. You could make 25 times your money again. You have plenty of time. You don't have to make money. My best stocks have been the third year, the fourth year, the fifth year I own them. It's not the third week, the fourth week. People want the money very rapidly. It doesn't happen that way. You can be very disappointed in the stock market.
Let me bring John in, because you told me last time we talked on the air that you were now holding stocks for an average of 5 years. Is that still true?
Yes, Louis. We don't intend to hold them 5 years, but we find if you buy things when they're terribly unpopular and depressed, they don't suddenly come back. You have to be patient.
Peter said the market in the end is fairly valued. You've made a career of seeking bargains, so you sometimes must think it's undervalued here and there.
Very much so, yes. Very rarely is any share valued for its true price, or true value. They go in a single year's time 50% too high and 50% too low. So it really pays to judge the values of corporations by the thousands in order to be able to tell which one has the lowest price today in relation to its true value.
This past weekend, I was with a group of academics. I mix with all segments of society, and they told me that nobody can analyze stocks, that it's all just a random walk and a very efficient market, and that the kind of advice that you people give and the kind of analysis you do is worthless. How do you reply to them?
That's just resigning from the game. If you take the game of tennis, there are exactly as many losers as winners, but that's no reason to give up playing tennis.
Good for you, John. Peter, you talked about the mistake of impatience. What are some of the other mistakes people make? And then let John answer that as well, but you start.
Well, it's obviously not doing the homework and not looking to the company. I mean, if you don't know what they do, you have a rough start, because the market in the last 20 years had 10 declines of 10% or more. And great companies go down. And in those declines, you have a great opportunity. I remember when the market went down in 1987, Dreyfus fell to $17 a share. They had $17 a share in cash. I mean, that was ridiculous. So you have to take opportunities. Most people have the brain power. Almost everybody on this planet has the brain power to make money in the stock market. The question is whether you have the stomach for it and whether you're willing to do a little bit of work. Those are the key elements. It's not that hard. If anybody had looked at Dunkin' Donuts, or if they looked at General Public Utilities, I looked at General Public Utilities 2 years after 3 Mile Island. It already doubled, and I was able to make 4 times my money on it. The company was solid.
What's your answer, John?
The main thing that people need to learn is that selecting assets is totally different from almost every other activity. If you go to 10 doctors and they tell you the same medicine, that's the thing to take. You go to 10 engineers to build a bridge, they tell you the same thing, that's the me. But you go to 10 investment advisors and they pick out the same asset, you better stay away from it. To say the same thing. To say the same thing in other words, the time when an asset is selling at its best bargain price is when most people are trying to sell. There's no other reason why an asset will go down to a bargain price. And if you wait until you're through the tunnel and out into the sunshine, you'll have to pay a premium price. If you even wait until you can see the light at the end of the tunnel, you're already past the best bargain days.
Many people think it's foolish to be a long-term optimist because we have so many problems in this country. There's problems of debt, public and private, problems of less than perfect political leadership in either party, problems of a growing international competition. How can you buy stocks? Why don't you just run for the hills?
Well, the beauty of a stock is if you put $1,000 in a stock, all you can lose is $1,000. I mean, I've proven that many times. If you're right,
companies,
yeah,
does the overall state of the economy not affect you at all?
You never can predict the economy. You can't predict the stock market. But when you look at Dunkin' Donuts, you say they have the best donut chain. You don't have to worry about Korean imports. You don't have to worry about what's happening with M1 and M3B. You just say to yourself, they're doing well.
We know what to give you for dessert.
That's what all gets down. What happens to the company, you don't own a lottery ticket. Time is on your side. when you own a stock. You work with that company and you'll do well.
What do you think, John? We look to the future. You never think it's a dark future, but what do you say about these problems?
There will be bear markets about twice every 10 years and recessions about twice every 10 or 12 years, but nobody has been able to predict them reliably. So the best thing to do is to buy when shares are thoroughly depressed, and that means when other people are selling.
Is this one of those times right now?
In all of my 50 years of investment counsel, I cannot recall a month in which there was such almost universal pessimism as there was last month in October. So that doesn't prove that we can't get still more pessimistic, but if you're already the most pessimistic in 50 years, you must be somewhere near the bottom.
At the start of the past decade, you electrified our audience by predicting that we could get to around 3,000 in the next decade. They laughed when you sat down to play, but it turned out to be almost precisely right. Carter has now stolen a march on you. He's predicted 10,000 in 20 years, but what do you see in 10 and 20 years?
I think the next 20 years will be just as marvelous as the past 20. In the past 20 years, the standard of living has gone up 60%. The earnings have gone up threefold. The dividends have gone up threefold. The gross national product has gone up fivefold. And I would think our studies indicate that that would be what we expect for the future, including share prices. The share prices have normally doubled in America about every 10 years. So 20 years out, they should be 4 times as high.
People say to me, John, now you're approaching middle age yourself, so when you get there, you'll have to answer this question personally. People say to me, gee, I'm 62 years old. I can't afford to buy stocks. I need income. What do you say to those people?
They would come out much better if they would buy a well-managed common stock fund and then just tell the fund to send them what income they need to spend. Almost every mutual fund will send you whatever you request per year, per quarter, a month. So it's a standard system, and if you trace it back, investing that way will give you the income you want plus capital gains.
Peter, do you believe that stocks will continue to outperform other investments?
Absolutely. Particular stocks, you have to be very careful. That's the key point. Some stocks, in the next 20 years, a lot of money is going to be made, a lot of money is going to be lost. I think the people that gamble and they buy options, what a tragedy if you're right on a company and you have a 3-month option on it or a 6-month option. Time's on your side. If you own the right companies and you follow them, some people are playing, it's like playing poker without looking at your cards. They're playing bridge without looking at your cards. They own companies and they don't look at it. They call their broker twice a day to get the price of the stock. That doesn't count. You have to do a little bit of work. You have to be out to the malls, maybe a half an hour a month looking at why do you own this company. If the reason is this sucker's going to go up, that's not a very good reason.
You said earlier that you like companies to have earnings. You realize that many brokers will think that's needlessly picky.
Well, when I look over the last 20 years, I think more of the turnaround at Chrysler, the turnaround of Ford, the turnaround of Boeing. You have to say to yourself, does this company have a reasonable chance of turning around? Do they have good products? And are they going to be solvent? It'd be really sad to own a company when they're doing badly. Because I used to follow the textile industry. They had a great expression. It's always darkest before pitch black. When you thought things were bad, they always got worse. So you want to look to see, is this company going to be around? Very important statistic.
Thank you both for your common sense and your optimism at a time when we need both. We look forward to years more of your very special wisdom from both of you. One thing we've often been asked is why we didn't do a 1-hour special filled with tape highlights of the most memorable moments of the past 20 years. Funny you should ask, folks, because by an amazing coincidence, we're going to do just that next Monday night. And here's an advance peek.
Join us for a special hour featuring some of the most memorable moments of the first 20 years of Wall Street Week with Louis Rukeyser.
When you begin to look at the world of the 1990s, I think the United States comes down a notch or two.
Should we abolish the Federal Reserve Board?
Yes.
What would you replace it with?
A computer.
Well, what is your attitude toward money?
That it's a very nice thing to have.
How can we become more competitive in America?
By a return to excellence.
On most PBS stations, Monday evening at 10 p.m., 9 Central Time. Check local listings for time in your area.
There's an awful lot of fun in that hour, too. I'll just tell you about 2 of my own favorite segments. One has amazingly accurate predictions we've heard over the years. The other has amazingly inaccurate predictions we've heard over the years, and I think you'll enjoy them both. And next Friday, our regular program will be back to the International Financial Center of Owings Mills, Maryland, and back to what passes for normal around here. My guest will be Kenneth Hackle, an expert at figuring out how much cash companies really are hiding inside their corporate cookie jars. But I can't close tonight without paying tribute to the real stars of the past 20 years. And they are you, the viewers. 20 years ago, all the wise guys were sure you didn't care that much about what was happening to your money, and that you certainly wouldn't watch a television program on the subject. Thanks for proving that the wise guys were really dopes. And let's go on proving it together for many years to come. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you. By the Travelers, insurance and related financial services working to provide financial peace of mind for over 40 million Americans. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Beach Securities. Rock solid. Market wise. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.
Local broadcast of Wall Street Week is made possible by Peterson & Company, a San Diego CPA firm providing audit, tax, and accounting services since 1951 to individuals, trusts, partnerships, and corporations, including registrants with the Securities and Exchange Commission. Wall Street Week is also made possible by Union Bank. Union Bank is proud to support quality programming on KPBS. Union Bank, offering the personal service of a local bank with the strength and resources of a major business bank. At Union Bank, we bring it all together.
The year is 2050. The greenhouse effect is no longer a theory. It's a fact of life on Earth. But the world is a very different place because of 20th century consumers, industrialists, and third world exploiters provide